You spent weeks perfecting a trading algorithm. The backtest looks like a flawless 45-degree climb to the top right of the chart. But the second this system goes live, the equity curve falls off a cliff. Most traders treat backtesting like taking a history exam when they already hold the answer key. When you run an optimization on a single block of past data, the software simply searches for the exact settings that would have made the most money during that specific time frame. It finds a coincidence, not a predictive edge. This is called curve fitting. You end up tuning your strategy to the random noise of the past, rather than discovering actual, repeatable market signals. To stop burning through real capital, you need a way to filter out those historical illusions. You need a rigorous mathematical BS detector. Professionals use walk-forward analysis. Instead of running one massive test, this process subjects your strategy to a sequential gauntlet of simulated futures. The first step is to split your historical data into two distinct camps. You have an in-sample training set to find your parameters and an out-of-sample validation set that acts as a completely blind test. The strategy is never allowed to see that second set of data during the optimization phase. If it turns a profit in training but bleeds money on the blind test, you have a curve-fitted system and you throw it out. But markets aren't static. A setup that crushed a highly volatile year might get destroyed in a tight ranging environment. To account for this, the analysis uses rolling windows. You optimize the system on one block of time, then run those exact settings on the very next unseen block. Once you have those results, you shift the entire window forward, re-optimize, and test on the next blind segment. By the end, you've stitched together a continuous string of pure out-of-sample results. You can structure these windows two ways. Anchored windows keep a fixed start date, continuously growing the pool of historical training data. Non-anchored windows maintain a fixed length, dropping off old data entirely so the strategy adapts exclusively to recent, fast-changing price action. Surviving this rolling gauntlet proves a system can maintain its logic through shifting market regimes. There's a trap waiting for traders who want a smoother equity curve: the urge to add just one more filter. Maybe a moving average to confirm the trend, then a time of day restriction. In data science, this leads straight to the curse of dimensionality, the mathematical trap of over-parameterization. Every single variable or hard-coded rule you bolt onto your system gives the optimization engine another loophole to cheat. It uses those extra parameters to mold itself perfectly around historical noise. A robust strategy relies on broad, undeniable market mechanics. It should survive the entire walk-forward process using a maximum of 3 or 4 core variables. To achieve that, you replace rigid numbers with dynamic logic. Instead of a fixed 50-pip stop-loss, you use a multiple of the average true range, so the strategy naturally breathes with market volatility. A system packed with highly complex parameters typically captures noise instead of a signal. A lean strategy remains effective because its logic is rooted in consistent price behavior. To know definitively if your strategy passes the test, you measure its walk-forward efficiency, or WFE ratio. This animation shows how the WFE is calculated. You take your annualized blind test profits, divide them by your annualized training profits, and multiply by 100 to generate an objective percentage grade. Looking at this gauge, if your score drops below 35%, the system is mathematically broken. Even if it produced some profit, the severe efficiency drop proves the initial results were curve-fitted. The target is the Goldilocks zone, right here in the middle, between 50 and 85%. Losing some efficiency on unseen data is normal, and landing in this bracket confirms you have a profitable, robust system. Ironically, if the needle pushes past 100%, you should be cautious. Performing better on blind data than on optimized data is highly unusual and usually points to a temporary lucky streak. Once a strategy clears this threshold, there is one final step before full deployment: incubation. You run it on a small live account to ensure real-world spreads and execution slippage don't break the math you just calculated. Never risk your capital without demanding an efficiency score above 50%. A messy strategy that passes a blind test is a reliable tool, while a perfect historical curve is often a liability. To put your own system through the gauntlet, test it using FXNX's advanced